Joseph, through the banking crisis in all of its forms over the past 5 years, Standard Chartered was one of the few stable areas delivering growth and an attractive investment proposition. Now that the banks in Europe and in the States seem to have cleaned up their act a little, Standard Chartered is undergoing its own form of crisis. What's the latest today?
It came out with a statement just confirming things are still pretty much going wrong. For the first time, actually, they've disclosed numbers in their interim management statement. Before, it was just sort of textual, really, saying how things were going.
It's always been very vague at Standard Chartered. They've always talked about double-digit increases here and there.
I mean, they're getting there. They're coming up with numbers. The problem is the numbers just aren't that great. Revenues, also like $4.5 billion. I mean, they grew, but they only grew 1%. And if you look at, say, like financial markets, so where fixed income trading and so on happens, on Wall Street, for example, that's improving a lot in terms of revenue in the last quarter. No sign of it at StanChart.
Any signs of any improvement anywhere? Is there any case to hold the shares in this bank?
Well, it's cheap. Yeah? It's about 1 times book, and it hasn't been at that multiple pretty much this century. And you have to remember that you opened by saying this had been a good bank. And yes, it has a return on equity of about 9%. Which you're not going to find, even in those rebuilding European and US banks anywhere really. But it is so geared to emerging markets. And like I said, in the good times, you don't want to own anything else. In the bad times, there's nowhere else to go on the balance sheet. You have to compare it to HSBC, which has US mortgage exposure and so on, so that when there is an EM slowdown, there is somewhere to go. There's nowhere to go for StanChart. And the really interesting numbers, and by interesting I mean mad, are its impairments. They grew by $500 million this quarter. It seems to be sort of large clients in emerging markets, particularly with commodities exposure. The market really didn't see those coming. If they're large clients, then that suggests that there are just a few sort of bad borrowers. But you have to wonder if it's a sign of things to come. And for the first time, they've said they're watching China, not just India, where issues were known, but China as well in this context of a commodity slowdown.
It's pretty bad news anyway. What can Standard Chartered do about this? Are there anywhere for it to go, any sort of areas of safety?
I mean, it's come out with a kind of strategic refresh or a promise of $400 million or so in cost cuts. Well, look, aim those at financial markets, clearly, because if it's not taking part in the fixed income rebound, then clearly costs have to come out there. In particular, the cost to income ratio for the first 9 months of this year is about 55%, which again looks good compared to like UK banks, for example. But internationally, it should be, in terms of what they do, they'll always have a great trade business. In terms of commercial banking and so on, that they should always have that edge, but that should be a low cost and in particular sort of quite credit quality business. So that's what they need to do, to sort of focus on that.
Perhaps then some opportunities there for the brave. Joseph, thanks very much.